Most people don't lose money because they make bad decisions. They lose money because they own assets that quietly stop working. Same income, same savings, same effort. But when the system shifts, one person gets richer and the other one starts over. Not instantly, silently, until one day they realize their money didn't disappear, it just lost its power. And by the time they notice, the gap is already too wide, because loss doesn't always feel like loss. Sometimes it feels like standing still while everything else moves forward. My name is Oliver, and I focus on one question: what actually holds value when systems change? Not when things are stable, but when the rules shift. Because if your assets only work in good conditions, you don't have a strategy. You have exposure, and exposure looks safe until pressure reveals the truth, because stability hides risk, but change exposes it. And that's where real strategies are tested, not in growth, but in survival. Most people think wealth is about accumulation, more income, more savings, more investments, but that's not the real game. The real game is survival under pressure, because history is consistent. 2008, $19 trillion wiped out. Not bad decisions, wrong assets. 1970s inflation. Cash lost 50% plus purchasing power. Not overspending, wrong positioning. 2022, $30 trillion erased globally. Same pattern, different trigger. Same mistake. Owning assets that depend on stability. And stability never lasts forever. Every cycle resets the scoreboard, and only certain assets survive the reset. The rest get quietly replaced. Two people, Daniel and Marcus. Same income, same discipline. For years, no difference. Then the system shifts. Inflation rises. Markets turn unstable. Daniel notices something subtle. His money is still there, but it's doing less. So he waits. Marcus sees something else. Some assets fall, others hold, a few increase. Here's the moment that matters. Daniel is forced to react. Marcus gets to act. Daniel protects. Marcus positions. And that gap, it compounds faster than income ever could. Because reaction is always late, but positioning is early. And early decisions create disproportionate outcomes. That's the difference most people never see. Money isn't static, it's system-dependent, and systems change constantly. Rates change, inflation changes, behavior changes, and when they do, assets don't respond equally. This is where most people lose money without seeing it happen, because they assume stability. But stability is the exception, not the rule. And assumptions are expensive, especially when they go untested, because what worked before won't always work again. And the market doesn't reward consistency. It rewards adaptability. Productive assets, businesses, equities, cash flow systems. Here's the reality. Volatility doesn't kill strong businesses. It gives them pricing power. While individuals absorb inflation, businesses pass it on. That's why they survive, and over time, outgrow the environment. Because they adjust faster than consumers. They adapt pricing. They optimize costs. And they expand when others contract. That's why productivity scales, even during uncertainty. Assets that can't be created on demand. Land, key commodities. When trust drops, people move to scarcity, because scarcity doesn't rely on policy, it relies on limitation. But here's the filter. Scarcity without demand is useless. Only scarce assets people need or value hold up, because value is driven by utility, not just rarity. And when both combine, scarcity becomes powerful, especially in uncertain systems. Cash is not protection, it's positioning. Short-term, it gives optionality. And optionality creates asymmetric opportunities. You buy when others can't. But here's the trade-off. Hold it too long, and inflation guarantees loss. Cash doesn't fail suddenly. It fails quietly. And that's what makes it dangerous, because it feels safe while losing value every day. So timing matters more than holding, always. This is the most ignored asset, because it's invisible, but it controls everything. If your income is fixed, you're fragile. If your income is adaptable, you're resilient. Because when systems shift, income flexibility beats asset stability every time. Skills compound differently. They increase your earning ceiling. They create new opportunities. This is where wealth scales. Owning systems, equity, IP, infrastructure means you benefit from growth you didn't directly create. That's leverage. And leverage is the difference between earning money and building wealth. Because effort alone doesn't scale, systems do. And ownership means participation in growth you didn't personally produce. That's how wealth expands, beyond time. Time is the only asset you can't recover, but it multiplies everything else. $5,000 per year at 7%, 10 years approximately $69,000. 20 years, approximately $205,000. 30 years, approximately $472,000. Same effort, same return, different outcome. Because of one factor, time in the system. And most people don't lose money, they interrupt compounding. They start late, they stop early, or they panic in between. And every interruption resets momentum. Retention twist. But here's what almost nobody tells you. These assets don't play the same role. Some protect, some grow, some only work in specific environments. And if you mix them incorrectly, you can still lose, even if you own all of them, because allocation matters, timing matters, and context matters. It's not what you own. So why doesn't everyone do this? Because behavior overrides logic. We're wired for survival, not optimization. So we choose certainty, comfort, immediacy, instead of structure, patience, positioning. That's why people hold too much cash, chase short-term returns, delay investing, not because they don't understand, but because their brain prioritizes now, and now feels urgent, even when it's not important. That's the trap. Short-term thinking in a long-term game. I don't have enough money for this. That's not the constraint. Structure is, because small differences repeated over time don't create small results. They create exponential gaps, not through effort, through positioning, because direction matters more than speed, and consistency beats intensity every time. At some point, the question changes from, how much do I make, to, what survives if things change? And once it happens, you stop reacting and start preparing. You stop chasing trends and start building systems. And once you understand that, money stops feeling unpredictable. You're positioned inside it, and positioning creates control. Control creates confidence, and confidence changes how you play the game.